Today's guest is Fred Thiel, the CEO of Marathon Digital Holdings. Fred is leading a public company that had been valued at $8 billion at their peak with 16 employees, today valued at around $750 million, which is astonishing. Previously, he led a project company called Sprocket that was building a exchange for cryptocurrency that they incorporated in Liechtenstein. He went there and established this business, and then the laws changed. And he tells the story of how he went from that experience to now leading Marathon, which is one of the largest Bitcoin mining companies out there, one of 14 publicly traded crypto mining companies. We talked about his specific strategy at Marathon and how it stacks up to other strategies in the Bitcoin mining space. We talked about how public companies shift and change, buy and sell over time. Marathon had many different lives as a publicly traded company prior to what it does now. And we talked about that evolution. A lot of the conversation, we talked about energy markets, nuclear, the role of renewables, how Germany has changed their strategy, how the U.S. is looking at Germany with respect to the change in their nuclear strategy, taking down the nuclear power plants they have, how nuclear plays into the future of energy production, and also in just understanding the nuances of the different types of energy classes and how the grid operates on a prioritization of stability and how different energy classes or energy types play into that stability. Fred really has become an expert in energy, as one would when they're leading a Bitcoin mining company. So very much enjoyed the conversation, learned a lot, and I hope you do as well. Here's Fred Thiel. All right. Well, just like that, Fred, we're live recording, and I'm excited to chat with you. I was digesting all the different projects and companies that you've been involved in, and I thought it'd be appropriate to start with where you are now with Marathon Digital Holdings, which has been public for a while and now is focusing on Bitcoin, or at least crypto mining. What was it that got you excited about this? And maybe walk me through a little bit of the restructuring of the company to focus on mining and where things generally are today.
Sure. So in kind of reverse order, Marathon used to be called Marathon Patent Group, and before that it had other names. Like many public companies, they go through a life and then they kind of go idle and somebody takes it over and does something else with it, repurposes the entity. Marathon was originally started as actually a mineral mining business, extracting vanadium as a metal, and then was in the oil and gas business for a while. It was in the real estate business for a while. And then it became a patent troll, effectively, Marathon Patent Group, and acquired a bunch of patents, one of which, interestingly enough, is related to the functionality of Siri and Alexa. And so Marathon had some success in prosecuting some patents. But then in kind of going after some of the bigger targets, they burned through a lot of money, and eventually the shell kind of was idle, and a group took over the company and decided to repurpose it for crypto mining. And a good friend of mine, the former CEO, Mariko Kumoto, was brought in to kind of head the business in 2017. And I joined the board in 2018 as part of kind of a restructuring of the company. And then stepped into the CEO role in late April of last year. But I got involved in crypto through a former colleague of mine who kind of went down the rabbit hole many years ago, very early in the crypto, in the Bitcoin days, and sort of had followed his kind of adventures down the space. And, by way of background, I come from a family that was very involved in the banking industry. My dad was a banker. My stepmother was a senior economist at the OECD. And so very familiar with kind of banking regulation. And I had run fintech companies before and had to do a lot of work relative to technology and financial regulation, and really viewed Bitcoin and crypto as a way to facilitate international payments, and as a great asset class that took you out of this mode of having to operate within these highly regulated financial markets and allow international trade to operate much more freely. and started really studying the space, looked at starting a company in the space, and wrote a white paper for a company that would essentially be an exchange that sat on top of all the other exchanges, such that you could have a unified order book, you could trade across markets, times of day out of one wallet. Because if you think back 5 or 6 years ago, it was really hard to move money into a crypto wallet. The banks made it very difficult for you. The exchanges couldn't take ACH or wire transfers typically. And then more importantly, if you wanted to trade in New York and there was a 10% price difference in Tokyo, how did you get money to Tokyo? And, Alameda Research and Sam Bankman-Fried's kind of first company made a lot of money doing that, trading that arbitrage between international markets. And so the goal with the company, that the white paper I'd written was, build a company that could essentially eliminate that friction and make it very easy to take advantage of those arbitrage opportunities. Tried getting it licensed in the US and very quickly realized that was never going to happen. Went to Switzerland, had extensive discussions with the Swiss authorities on it, and ended up building it actually in Liechtenstein, where the law firm that we used had helped craft the original crypto laws in that country. And built that, operated it for a while, and then they changed the laws in Liechtenstein. It was essentially would have required the business to be licensed as a bank. And at that point, the capital requirements and the legal requirements were just too onerous. And so,
wow. And that was Sprocket?
We got out of that business. That was Sprocket, correct, yeah.
Wow.
So
and up until that point,
story.
How much time or how much capital had been deployed into that project?
It was a lot of time, but not a huge amount of capital because, having been in the startup space for a lot of years and then, general partner in a venture firm, you want to keep kind of startups starved a little bit until you can really validate the use case. And, the focus initially was really licensing. And once you had the license, then it was a question of operating. And what we quickly realized was that you look at between the full building out the full tech stack and getting the full licensing done with the banking license and all that it was going to cost hundreds of millions of dollars and just made no sense at that point. Yeah. I mean, you need a basic capitalization of, at the time it was $120 million or Swiss francs. Liechtenstein uses Swiss francs as a currency, just to be able to operate. And then on top of it, you have to have a lot of people, you have to have a lot of processes because you have to have a banking license. And it takes years to get. And so when you look at kind of the speed at which the market was moving and what was going on, it just, as a venture capitalist, it was like, I don't want to take this risk. But needless to say, it was a great experience.
Did you move to Liechtenstein to do this, or did you have to move if you were to do it?
No, I spent a lot of time going back and forth. Now, by background, I was born in France, and my parents are both Swedish, so I spent a lot of time of my life living in Europe. And so I sort of commuted back and forth on a pretty frequent basis.
Was that a difficult experience, like emotionally, to have effectively the rug pulled out from under you when they made the regulatory change after you had already sort of set some roots in Liechtenstein?
It's always difficult, right? I mean, emotionally, you're vested emotionally in any project you're doing, and you're excited about doing it, and then all of a sudden, it kind of, something happens that makes it not work. It's kind of like, imagine if with Marathon, if the government were to suddenly prohibit Bitcoin mining, it's like, not a lot you can do other than try and move it offshore. But the life of an entrepreneur is constantly dealing with risk of failure and the emotional issues related to that. And you learn from all your lessons, and it kind of becomes another knowledge set that you add to your kind of quiver of facts and experiences that you then use for your next venture. There's this old saying, to have good judgment, you have to have experience, and to have experience, you've had to have had bad judgment. Yeah, you learn from your mistakes, right? So
yeah. There's another good saying that's a fool doesn't learn from his mistakes. A wise person learns from his mistakes, and a genius learns from the mistakes of others, which hopefully is something I try to think about. Did I was going to ask you another question on the Sprocket. The specific regulatory implementation that was forcing you to become a bank, was it holding customer funds abroad, or what was it that was core to the business model that you just couldn't get away with doing without becoming a bank?
The original crypto law that was put in place in Liechtenstein essentially treated Bitcoin and Ethereum as currencies. So you could trade them as currencies. So you only needed a foreign exchange bureau license. That's what made it feasible to operate the business. And so essentially what you're doing there is you're, buying on one side of the market and then selling on the other side. And you operate it like an OTC desk, essentially. And it was taking it from that step to a full-blown automated exchange and market maker that would require you to then go into the banking space and essentially have a banking license. And then they shifted the kind of how they viewed anybody trading crypto as saying, okay, now if you're going to trade crypto, then you now need to have a banking license. And that's what kind of put the nail in the coffin.
And was it custody specifically as a company, if you're controlling customer funds, that would make you eligible?
So a couple of things, in an OTC model, essentially customer wires you money, you do a purchase, and then you send the coins effectively, and vice versa on the other side of it. So you're never holding customer funds. So again, to become the automated market maker and exchange, we were going to have to custody funds. We were going to have to hold deposits. And while you can hold deposits for a limited period under the license we had, we could hold customer funds for 90 days. You can't essentially, have an open account where the funds sit there and people are actively traded. So, again, it's all kind of, early days in the industry. You're out there ahead of regulation. And, it was like in the US when we looked at doing this. In the US originally, it was, you're going to have to get money transfer licenses. You're going to have to get all these other licenses. And, in a regulatory, sort of high risk regulatory environment, you are taking a very big risk when you're trying to do something and dealing with the regulators that haven't yet created rules. It's different if the rules exist and you're trying to get kind of, whether no action letters or whatever it might be. But it's always a bit of a challenge in that regard. But, that's the thing with the financial markets. And, regulation is a game of whack-a-mole. New technology comes out. Oh, we need to regulate this. What are we going to do? And it takes time. Just look at the crypto market in the U.S. today. Look at how far behind the U.S. is compared to some other countries in the regulatory frameworks that we have here. And it'll eventually get all sorted out. But it takes time, and the companies that kind of are on the wrong side of the regulators, get penalized for it. And I think, this washout we've seen with the crypto winter we're going through right now has actually been, unfortunate for investors and the people who traded on some of these platforms that were impacted. But it's very healthy for the industry overall because it washes out this kind of, success at all cost and, hunt for yield that existed for a while in this marketplace. And that you take that speculation out of the marketplace, it deflates the market initially, but what it does is it creates a market that's much safer afterwards, because now the regulators know what can go wrong and they know how to build regulation frameworks that will function around it, that'll make the market safe. And at that point, the real institutions can come in and actively get involved in the market. So while it was a very bad thing for the investors who lost money and, the employees of companies that have lost their jobs and all that, like any evolutionary marketplace, when you start with revolution, it then shifts to evolution. And as it evolves, it gets better. And, you got to realize that the equity trading markets are hundreds of years old, but most of the regulation around equities trading have only happened in the last 100 years, really since the Great Depression. And so, the crypto market's still very early. It's, 13, 14 years old, based on the age of Bitcoin. And we've got some ways to go, but I think it'll be much healthier coming out of this. So over the next 5 years, I think we'll see a lot of good progress.
Yeah. Do you think it's specifically healthier when the government regulations come in to like make things safer to effectively try to outlaw some of the pyramid scheme projects that were going on? Or by contrast, I wonder if the retail market is just more sophisticated now and understanding the effect of these organizations, that when they manage people's money, well, you have to now be a detailed, thorough investor to look at, well, how do they manage money? Where is it sitting? Whereas you kind of don't have to think about that in the traditional fintech market, because you kind of have an assumption that maybe the banks are underlying all of the GUI interfaces like Venmo. Like ultimately there's some bank that holds custody over your money, and that's probably FDIC insured. Whereas in the crypto world, clearly things can go wrong. I'm wondering if there weren't regulations that were reactionary in this today, as we sit here in July, a month after everything just kind of shook down, do you think things would just kind of naturally evolve to become more sophisticated and prevent that sort of thing from happening again? Or is it really going to take regulation to protect people?
Yeah, it's so I think a way to look at it is anything new has a lot of excitement around it. And there's a technology analyst firm called Gartner, who for decades has been kind of giving companies the view on the implications of new technology. And they have a concept called the hype curve, which is this chart where you see this huge slope upwards. People are all excited about a new technology. And then they go into this thing called the trough of disillusionment, which is when you realize it might not work quite the way everybody thought. It's impractical. Web 3.0 is starting to go through a bit of that now, where people are saying, well, what's the real use for it? And how does it really differ itself from Web 2.0? So crypto's now gone through that. We're now in that trough of disillusionment in the depths of it. And when you come out of that, you come out into this phase where it's real commercial implementation, and the financial markets really take it on, because now it's safe. There are guardrails. So regulation is important because institutional investors want to make sure that they're protected, both from the government coming in and making a sudden change, but also from people doing things that they shouldn't do. So, for example, there is no amount of due diligence you can do reasonably to validate that somebody like a Celsius or Three Arrows or somebody like that is doing everything as you expect they should be doing it, with that level of prudence and safety and risk averseness. Now, I think most people, if you were to say, hey, I've got an investment idea, it'll generate 18% annual yield, most people who are reasonable would say, yeah, that's most probably a scam. And if you think about how a lot of these companies were generating yield, they were taking somebody's Bitcoin or somebody's Ether, they were then staking that, and then they were being able to get a liquid version of that and then investing it somewhere else and getting some more. And they would make 2 or 3% on this kind of stack of yield that was happening. But that can only go on as long as the market is in a growth phase. So again, it takes somebody with a lot of experience and the ability to distance themselves from the excitement and hype to think about, is this really reasonable what people are saying and doing, and can it last? And I know, for example, a lot of companies approached Marathon because, Marathon holds a lot of Bitcoin, and said, God, you guys should really invest, take your Bitcoin, give it to us, we'll generate a yield for you, it'll be great. And some of those companies that approached us are companies that no longer are solvent.
Ouch.
And we didn't. We were very conservative. We said we don't want to have risk of, counterparty risk. Now, I've lived through the 2008 crisis. I lived through the dot-com bomb. So, from that perspective, we're very conservative in how we manage our assets.
How does this compare? Just a quick question on that. Just the consensus view on the emotional reaction after the bomb. I was born in 87, so 13 around the turn of the century. Certainly remember the 2008 crisis, but it was much more directionally in real estate than in tech. How does this compare? I mean, this feels to me pretty bad because companies just collapsed. It wasn't like, I mean, they collapsed effectively due to fraud. I mean, the CEO of Celsius tried to flee the country. How do you, what's your sense of the aftermath in this situation?
So, from a tech industry perspective, this is like a combination of the '08 crisis, the Madoff collapse, and the dot-com bomb. Because think about it, the last 2 years, companies in this industry were able to raise capital at amazing amounts. I mean, Marathon raised a lot of money as well, but companies had easy access to capital, and when there's easy access to capital, people get sloppy. And, you kind of think that access is not going to end, and they don't operate their businesses very prudently. And then all of a sudden, if you're competing against somebody and you're offering 10% yield and somebody else is offering 12%, it's like, okay, I've got to offer 14% now. And, this competitive aspect in the upmarket and their counterparties willing to do those business deals. There were companies that were lending money to Celsius and others at rates that were very reasonable. And so they could, literally pile on the money on these deals. So you've got this greed factor that kicks in, and, not unlike GameStop, look at all these retail traders who went in and ran the stock of a company that really had no reason being valued the way it was. The greed factor kicks in. And, while people think about the crypto market as, it's this, multi-trillion-dollar market, compared to the equity markets and the world, the trading markets, it's still very small. And it doesn't take a lot of people to move the numbers in the crypto world. And so, you saw this huge wave of people getting into it, and everybody was seeing dollar signs, and, Bitcoin was doing nothing but going up. Ether was doing nothing but going up. All these other coins were going up, and it was like you could buy into an altcoin and flip out of it within 2 or 3 weeks, make 100% on your money. It was easy money. People get sloppy, and they get careless, and they get greedy. And so I think, it's this combination of companies raised a lot of capital. Now you've seen, it's very hard to raise capital for a crypto business today. That's not available. Interest rates have gone up, so debt's very expensive. You had people invested a lot of money in entities that were insolvent. So that's the '08 crisis, right, where Bear Stearns, Lehman Brothers disappeared. And then you have, actual crime or fraud, if you would, by some individuals. And, it's this combination of the three. What is amazing, though, is to think about all of these things that have happened, the macroeconomic environment, the Fed raising interest rates, we're getting ready to enter into a pretty bad recession, most probably. You have, the equity markets, dropping by, 30 to 50%. I think the mean Nasdaq stock dropped 60%, most probably, while the Nasdaq overall hasn't dropped 60%. If you look at the median stock a decline in the market, it's most probably 60%. The crypto companies dropped a fair bit more than that. So you have all this money that's been essentially lost and evaporated in the marketplace. And it's happened in a very short period of time. And, people have, I'm not going to say people have learned lessons, but I think a lot of lessons have been taught. Hopefully people will learn from them. And what you're going to see is a much healthier business going forward. You're going to see people more prudently capitalize their business and not overcapitalize them. You're going to see people take risk that is more measured. There are companies in the mining space who went and raised money, used all that money to buy infrastructure and put a deposit on miners, saying, I'll go back to market and raise more money to pay for these miners. And now they can't, and they're in trouble. That was not the model we used at all. When we built the business, we built it much more prudently. But I think, it has to do with how experienced management teams are, how many times have you been around the block, and do you know how to properly diligence deals, diligence providers, things like that. So, but listen, we're all learning lessons every day, continually. Yeah. I mean, I certainly learn lessons on a daily basis still. Yeah, and I've been in the tech industry for 40 years at this point.
Yeah, so. Yeah. Do you feel yourself get caught up in it? It's if we were to have this conversation 4 months ago, would we have the wisdom to recognize the inflated valuations and overzealous attitude that people have across the industry? Or we're like, hey, this is great. You recognize that things are growing quickly. But there's also, I find it's very difficult in those moments to know how long it'll last. It's hard to make a conservative bet. Like let's get out of this deal, whatever it is, and play a more conservative role. And then, does it last another 6 months or a year or a couple of years? I don't know.
Yeah. I think the counterparty risk issue relative to the yield, the hunt for yield that was going on, I think that, I know certainly I was very skeptical of it because it didn't pencil for me how you could do it. So I think if you were to go back a year ago, we were all very caught up in the price of Bitcoin continuing to go up, and where does it stop? Is it going to go to 100,000? Is it going to go to $200,000? Are we going to have another crypto winter? And I think the general expectation was that the cycle would not be very similar to how it had been before, but there would be some similarities to it. So, at what point, how far down would Bitcoin drop if it did drop? And, we had a couple of drawdowns last year. And, if you look at kind of when we did our last capital raise last year, which was in November, we did a convertible bond offering. That was most probably right at the peak of the market. So it was, serendipitously well-timed. And we didn't know it was the peak of the market, but we felt that, the market can't go much further than this. So now's the time to do this.
Yeah. Well, that's a good move.
Yeah. Now, at the same time, we're a hodler. Most of our peers have gone and sold, a lot of their Bitcoin holdings. We haven't sold any Bitcoin since 2020. So we're still long-term believers, and, the markets are behaving nicely today. So, it's a nice update for us all, but we'll see how it plays out.
Yeah. And help me paint the landscape a little bit of the public market mining companies. Like how many of them are out there? What's the sort of distribution of sizing and mining power? And what do you see as the competition? Is it purely on who can acquire the most capital to buy the most machines, or is it on the specificity of the type of energy usage that different miners have, or are there other strategies that seem to be promising?
Sure. Great question. So, at this point, I think there are 14 or 16 publicly traded miners, at least in the US. You have some others that are traded in other international markets. And most miners have a business model where they invest in infrastructure. So they essentially find an agreement to get power from a power provider. They then find a site. They either lease land or they buy land, and then they build a facility, and then they go order miners to put in that facility. And that takes a lot of capital. If you look at your typical installation, your data center, and once it's stocked with your miners, about typically 60 to 70% of the capex in that are miners, and the balance is infrastructure. Our model is very different. We believe in an asset-light model, so we don't like to own the infrastructure at all. So it gives us a couple of benefits. One is we're agile, meaning because we're not dependent on one physical site where we're going to operate. As we grow, we can pick and choose wherever we want to operate. If regulation changes, if states have better rules, if power is more readily available at a lower cost in a location, we have the ability to kind of chase the best deal because we're not sitting on a lot of real estate or physical plant assets that we're developing. And all our capital goes to just buying miners and operating. And that's why you compare us to like a Riot, for example, or a Core, who have hundreds of employees and have physical sites that they're operating and managing, and that they're having to, borrow money to go fund, to invest and build the infrastructure. We don't. We have 16 people, and we operate in a very lean model. And we're able to work with a variety of hosting partners. And you could say in a very tight market, while being vertically integrated like a Riot or Core, you control your costs more. You also create rigidity in your business model. It's very hard to change kind of where you operate and how you operate because you have all that sunk cost. If in a market where the Bitcoin price is going up, our model clearly is superior, and we'll have to see. kind of, which model plays out as being a better one. But the vast majority, I think there are only one or two miners that really operate using our model of the public ones. Now, part of the challenge is that, Core, Riot, ourselves, we're kind of the top three of the publicly traded guys. And then you have kind of Argo, Hut 8, Hive, et cetera, and a bunch of people below that. So what you're going to see over the next 12 months is, who continues to grow and who doesn't. And while I can't comment on Riot's or Core's growth plans, because I don't know them, I do know, we're deploying, 23 exahash of hash rate. We're effectively growing sixfold, in these 12 months. And because, those miners are predominantly fully paid for at this point. So we're just tying up the hosting arrangements so we can deploy them as they get delivered. Whereas for Core or Riot, they're still paying for infrastructure build out. And so their requirements for their capital is not just for miners, but it's for core infrastructure also. And some of those companies have debt that they need to service. And while the price of Bitcoin has been down, they've had to liquidate Bitcoin to pay and use for paying for debt servicing or for paying for their infrastructure build outs. And this is all publicly available information based on kind of announcements they've made. So I think it's the models are different. I think there'll be a shakeout. There'll be a certain amount of consolidation of the smaller players. There are a lot of miners who invested in infrastructure and put deposits on machines who now can't complete the payments on those machines. So that's why you're seeing mining rig prices dropping so low in the marketplace today. And being a large volume buyer of miners, we have bought most of our fleet using arrangements with the vendors where either we have price protection, so if the price of mining rigs drops, then we get our price effectively drops, and we get credited back for that, or we just bought at very low prices. And so if you look across our fleet, the average cost of our machines is quite low actually compared to the over market. So it comes down to how you operate your business. But I think more important question, you look at the global hash rate growth. Biduda's forecast originally had 2022 ending somewhere in the 340 to 360 exahash, which would have been an 80% increase over 2021. And now it looks like we'll be flat to kind of the end of 2021 this year, maybe 220. I mean, maybe 275.
2022, right?
Higher. Yes, correct.
Yeah.
So, the number's substantially taken down from where the estimates were expected. And then we'll have to see where 2023 goes. But I think the growth in hash rate is going to be slower than what people were estimating last year. Certainly.
And your model is specifically that you said you own the hardware, but you have hosting providers that manage the hardware. Are there separate companies that you'll lease out the hardware to that then manage it, or how exactly does that work?
Well, think of it as a data center operator, right? We work with people who operate Bitcoin mining data centers.
Got it.
And so they tie up the power, they make the investment in the infrastructure, meaning the transformers, the containers, the buildings, if you would. And then, we contract with them to host our miners, and then they operate the miners on our behalf, or we will send people on site to do the kind of day-to-day operations as needed. But, we're not building sites ourselves. We're not, contracting for power, buying transformers, doing all that build out stuff.
And so what the key strategic goals of Marathon, for instance, taking this model will be to find the locations and set up the contract agreements with both the local energy providers and the like the Bitcoin mining management companies. Is that right?
Yeah. Think of it as we're either partnering with a company that is doing that on their own. So they're contracting for power. They're building a data center for Bitcoin mining. And then, they want a large tenant, if you would, like us. So no different than a real estate developer who's building a mall. They need an anchor tenant. We're the anchor tenant. So they're building a mall. They need retailers to come in and essentially drive traffic and make it a place where other people are going to want to be. A lot of times we'll go into sites as the only tenant because we're so big. So for example, our site in Texas that's currently being finished, that'll be 280 megawatts. We'll have nearly 70,000 miners at that facility. Then there's another site that we're going to deploy another large number of miners to as well. So it's a business of kind of specialization. You're either really good at sourcing energy and building a data center and operating kind of your miners, or you're really good at raising capital and deploying that capital in a smart way. We focus really our efforts on return on assets. So our whole goal is to be the best custodian of our shareholders' assets and generate the best return on those assets, as opposed to having a lot of real estate and a lot of data center assets.
That's interesting.
Because you look at and this is maybe just because I spent time in the private equity world, I spent time in venture capital, I have this kind of return on assets mindset, but we just think it's a better model.
Yeah. And so do you end up having more locations where you have more smaller locations, or does it play out where you're targeting certain types of power plants or electric or other types of energy providers, or is it completely agnostic to the I guess what's a typical type of energy provider that you would partner with, like a landlord to your tenant example?
Yeah, great question. So we ideally want to situate ourselves what's called behind the meter at a facility that is drawing power from some renewable energy source. So for example, the site in Texas is built on the grounds of a wind farm, and we're drawing energy off the wind farm and then supplementing with grid energy when the wind's not blowing. And so A, it's renewable, the wind is renewable, obviously. And B, we have the grid as a redundant backup, if you would. That's kind of the ideal situation for us. In some cases, we'll sit just on the grid because it was an attractive opportunity, the power price was right, and there was capacity sufficient for our needs. But as you look across kind of the spectrum of our hosting sites, there are small sites, there are big sites, they're located in different states. We believe that you want to have diversity. A lot of miners, you can look at Riot, for example, they will be 100% in Texas and be really dependent on ERCOT, who's the grid operator there, for their power and their power pricing and all that. We believe that's risky.
Yeah.
You get a storm like the one that happened, a couple of winters ago, and, you could be out of business for a while. And, we had that experience ourselves in a small way. Our facility in Montana, the storm that took out part of Yellowstone took out part of the power plant that services our site in Montana. And so, we've been down for a period of time, and it's now being repaired and will be up soon again. But, it's those contingencies that, if everything is in one location, those are the risks you suffer. So, we're very focused on site diversity, partner diversity, and, vendor diversity.
It's super interesting. Yeah, I would think I've heard a lot of the counter narrative to the criticism that Bitcoin miners get around energy usage, just with this makes sense, right? It's a concern that gets voiced in the media, which is why use a cryptocurrency that consumes so much energy when you could use proof of stake or other consensus options. And it seems to me that a good counter to that narrative is that you as a Bitcoin miner can develop your infrastructure in places that are underpopulated or are remote locations that wouldn't have any demand for them anyways. Like I had some guest on about a year ago that I forget the name of the company, but was an investor in this business that takes the excess natural gas burn off in Texas and harvest that with these little, Bitcoin mining rigs that sit on top of them. And it makes perfect sense, right? They're wasted. It's wasted energy. There's no other use for it currently today. And I mean, do you see that kind of being the competitive landscape as well, where you're just trying to target energy sources that are cheapest, and they're effectively cheapest because there's no demand because they're off the grid or far away or some other reason?
Yeah, so you have this concept of stranded energy. So West Texas is the perfect example of this. So the grid was designed originally, the energy grid was designed to transport electricity from point A to point B. So where it's generated to where it's consumed, but it was really meant to load balance. So you build a lot of energy generation where you have customers, and then you use the grid to load balance. Meaning if you need some extra energy, you could take some from somebody else. Or if you have excess energy, you could give it to somebody else when they need it. What ended up happening with the build out of renewable energy and the incentives around that, wind energy, the wind was very, prevalent in West Texas. So a lot of energy companies went and built a lot of capacity. The problem is there isn't grid capacity to transport all that electricity. And so you have a lot of stranded electricity. So people say, well, Bitcoin miners are taking all this energy and it's not available to consumers. Well, that's not true, because that energy can't be transported to the consumers. And if you want the energy generating company that operates the wind farm or the solar farm to invest in more renewable energy, you have to make it profitable for them somehow. They have to be able to sell that energy. And so, we come in as a baseload customer. We consume energy at the point of power generation, so there's no transmission issue. And then, we'll shut down our miners if the grid needs the energy. We're absolutely happy to do that. And, that's the way most of our arrangements work, that we can curtail our miners, if the grid needs the energy. But what we do is we provide these energy companies with a baseload consumption that allows them to operate their businesses profitably, because otherwise they weren't selling their energy. And, there's a unique foible, if you would, to the energy markets, which is the grid needs stable energy. And so it prioritizes based on stability and, dependable energy generation. So the energy that primarily goes into the grid at the bottom layer, if you would, the foundational layer, is nuclear, because it runs 24/7, 365. Then comes coal. And you can't turn coal on and off very easily. So you run that consistently. Then you use natural gas, which you can turn on and off periodically as you need it. And last of all, you use solar and wind energy. And why is that important? Well, grid demand is not constant during the day. Grid energy consumption is peak between 4 p.m. and 9 p.m. at night. Well, why? Well, people come home, they turn on their air conditioning or their heating, they're cooking, they're doing their laundry, etc. During the day, we don't consume that much energy. And, by the way, in this country, for the past 2 decades, we've consumed pretty much the same amount of energy day in and day out, and it maybe goes up by 1 or 2% a year.
Wow, that's it. Huh?
So, so where's the incentive to build new energy, especially if that energy being renewable that's being built gets shut off first thing, right? Because if you're not in peak consumption period, they're not going to shut the nuclear off. They can't shut the coal off. They may shut the gas off, but they're going to definitely shut the solar and wind off. And so you're in this, it's this kind of, not paradox, but it's this challenge where, okay, you want me to build more solar and wind, I need to sell it to somebody. And so that's really the role I think you see Bitcoin miners playing. Now, granted, there are also hydro facilities in Appalachia that don't have a lot of customers, but hydro facilities are really expensive to build and operate. And I think what you are seeing, if you look at the kind of energy analyst data, basically coal facilities are being shut down. And people are building a lot of solar and wind, but the problem comes down to how do you get this dependable energy? Because, wind in some places blows during the day and other places at night. Texas, it happens to be late afternoon and evening. Solar is only available from kind of 9 to 3 during the day. And again, peak energy is 4 to 9 p.m. So solar doesn't really help that. So until you have energy storage and batteries and ways to store energy, it's going to be very hard to make all this renewable energy very profitable longer term without a customer like us to suck up that energy and use it. So we fulfill a public service, if you would, in that regard.
I like that.
Now, if you look at proof of stake versus proof of work, and granted, we could do a whole podcast series of multiple episodes on that if you wanted to. But I think high level, proof of stake, especially the way it's showing to be operated, there's a huge amount of concentration in proof of stake. And I don't know if you've followed the stuff going on in the Ethereum world now, but, a number of key people in the Ethereum world are saying, listen, we need to limit the amount of staking certain companies can do because they're getting too much concentration. And proof of stake is really not too different from the existing banking system where your bank vouches for the fact that your money's in your account.
Mm-hmm.
Right? In the proof of work world, nobody vouches for it because you control it, and it's in a wallet and you can see it on the blockchain. So consensus by proof of work is a much superior system. I don't disagree with people in saying that, the energy consumption of our industry is large. However, we are getting much more efficient at using that energy. And over time, I think we're going to find that energy consumption will not have a very big impact on consumers. And at the end of the day, the argument about the energy consumption is you're either talking about carbon emissions, and if you're using predominantly renewable energy, that's not an issue. And so what's the argument? Well, you're taking energy away from consumers. Well, if you're only using stranded energy and you're using excess energy, because by the way, Bitcoin miners don't want to pay retail for energy.
Yeah.
So we're not going to take energy from consumers. So I think there's been some misguided, the media and press have kind of colored the industry with a very dark pencil, if you would. And I think over time, people will realize that, you compare Bitcoin miners to financial institutions, and financial institutions use much more energy than we do. Look at Amazon, look at, Facebook, Google, they all operate data centers that use huge amounts of electricity. Nobody's complaining about that.
Yeah. I think you're right. I think there's also the need for media companies to draw up a drama, make it like, there's a good and bad guy out there. And like and it may just be a progression, more like an evolution, and it's simpler than what is described. And there's not as much of a debate, it seems to me, because you're not incentivized, like you said, to purchase retail energy costs. So you're always going to go to the places that are less desirable. And it does, I agree with you. I mean, I certainly buy the viewpoint that you're effectively funding the early prototypes and the early development of renewable energies and remote sources. I want to ask you, what's the current state of transmissibility? So if I have a massive solar farm in West Texas somewhere in the middle of the country with a lot of sun, if I'm piping that 100 miles or 1,000 miles, is there a pretty consistent energy loss, or is that energy loss? I've heard of some technology using like hypercooled or supercooled energy wires. Is that technology improving, or like what's the loss on per 100 miles or so?
So you can only transmit high voltage about 600 miles. So that's your distance limit. So, I can't generate electricity in West Texas and ship it to New York. So that's an issue. If you look at transmission losses in the US, it's somewhere between 4 to 15% of the energy generated is lost in transmission.
Wow, that high. Yeah.
And we generate 4 terawatts per hour of energy in this country, roughly. So take 5% of 4 terawatts, and that is more gigawatts of energy than the whole Bitcoin industry globally uses, is just wasted in transmission.
It's interesting. And do you see that improving, or that's relatively a fixed constraint on the system?
So I think what you're going to see over time is a shift to microgrids. So today we have a hub and spoke model. You have a utility that sits with a power generating facility, and then it ships energy out from there. Microgrids operate very differently. Basically, you take a community, you put solar or wind in that community. It's of a scale that's small enough that battery storage is actually quite efficient financially. And then you can put a little bit of Bitcoin mining attached to that to consume the excess energy they create, and that can help fund the deployment of that microgrid. And in Southern California, there's a project being done now to build out microgrids where I think it's either LA County or the city of LA, I forget which. They essentially were choosing between, do we fund a new gas plant for $4.5 billion, or do we fund microgrid development for $4.5 billion? And they opted to do the microgrid solution. So it'll be really interesting to see as that project gets built out, how efficient it is, because now you're consuming energy where it's generated. So there is no transmission. And now the need for the grid becomes what it used to be, which is simply to load balance. Hey, I need a little excess energy, or I've got some excess energy I want to sell. It's not, I need all my energy to come through you.
So are you telling me that the California state government made the right decision on
It's not the state. I think it's okay. The county or the city.
County or city. Do you generally have any criticism of either federal or maybe state, but federal policies on renewable energy? It seems like we're in a hyper aggressive and, from my perspective, not very sophisticated analysis of the type of regulation that would improve climate change, which is the end goal. It seems to almost be this pseudo goal of like renewables are the goal at all costs as fast as possible. And I'm just wondering if we're making a misstep somewhere, and I'm curious to hear your reaction on.
So I'm going to answer this in kind of a little more roundabout way, but I think the example is really relevant. So if you look at Germany, look at Europe, the environmentalists who, obviously have considerable say in parliament in Germany and the EU, essentially drove through the decommissioning of nuclear power plants and coal plants.
Yeah.
And said, let's run on gas. Well, now this Ukraine crisis happens, and what's happening? Germany's turning back on all its coal plants, and they're considering turning back on nuclear plants. So if I were a regulator or a government official in the US and I saw that example, I would say, what is the most reliable and safest form of energy that we have? And that's nuclear. So you could do things like SMRs, which are these small modular nuclear reactors. Now, nuclear is a challenge because on the one hand, you have spent fuel you have to deal with. But the other problem is that the vast majority of nuclear power plants built in the US are these large central utility plants that take years and years to design, years and years to get licensed, and years to build, and then they run over budget. They run way over budget. SMRs are modular, meaning they're cookie cutter. It's the exact same reactor. It's basically a handful of containers, if you would, that are self-regulating. They don't need all this water systems to cool them. They generate, typically less than 100 megawatts. So it's microgrid again. And, if you think about safety, how many nuclear incidents has the U.S. Navy had? Very few.
Yeah, it's a good point.
And these are small modular nuclear reactors, and this is what SMRs are. And so I personally believe that if the government really wanted to solve the energy crisis, they would go nuclear. They would do two things. They would deploy SMRs where it's practical. Most people don't want a nuclear reactor in their backyard, but there are places where you could put these, where you could substantially enhance the power generation at a microgrid level, and then really focus on fusion energy. And, we are getting close to feasibility on fusion. What fusion has as a benefit is there is no spent fuel issue, right? Fusion is like how the sun operates. It's essentially a flywheel effect based on helium gas and other things like that, but being done under pressure. But it's a very different model, but it is the ideal energy source. And so if you're not going to go the nuclear route and you want to go the renewable route, you need to have a way to store the energy. So we should be investing in energy storage technologies because it's one thing to store a few megawatts of energy. It's a totally different thing to store gigawatts of energy. And, look at what they're doing in Hawaii today, where, they're trying to get the Hawaiian Islands off of diesel, which is their primary fuel source for energy there. And, they're deploying lots of solar with lots of batteries. It's very expensive to do that. And, Hawaii has a small enough population that you can do it effectively. But you can't do that across the nation today in the US. And so you have to get your energy storage technologies and capabilities to a place where no matter what time of day you generate the electricity or its source, you can put it into a bank and store it and then use it later. And so I think it's this combination of energy storage technology meets better renewable technology meets some form of nuclear technology. Yeah,
meets a political appetite for it, which always seems to be the biggest problematic,
yes,
right?
And what's interesting is with what's going on in Europe today and this energy crisis. Listen, when gasoline or when oil is, over $100 a barrel and the price is dropping, and natural gas is at, very high prices and will drop. But, now's the time to kind of get the regulators to say, you know what, we maybe need to look at an alternative, because otherwise we're going to be, unfortunately having to rely on coal and other fuel sources for quite some time.
Yeah, it just seems to make so much sense. I mean, what are we now? About 15%, 20% of energy in the US is produced by nuclear? Like, it's not trivial. I mean, it's not that we're starting from scratch.
Yeah, but it's decreasing.
And are there, do you know if there's any current operational fusion plants in existence, or is that still experimental technology?
No, the tokamak, which is the technology that's kind of state of the art today, has been primarily developed by Japanese, Chinese, and U.S. and some Russian. They're now getting to a place where they're able to create a sustained fusion reaction for a brief period of time. And where before it was microseconds, now I think it's in the minutes you're measuring it, but you need to get into the days and years scale. So we're still most probably about 10 years from a commercially viable fusion reactor versus experimental scientific experiment, which, most probably in 5 years, we'll have solved the science of this. There's a huge amount of money going into it. Yeah. And, it's a major issue. Then there's also the alternative of generating power in space, right, where you have infinite solar energy. And it's just a question of transporting it to the Earth. Yeah, I've thought about that. Whether you'd have like a tether, like an umbilical cord into outer space, or whether it'd be beamed down or shipped down occasionally. Most probably beamed down is a tether, I think, is just, there's way too much risk with that. Just anybody who's read the Foundation series by Isaac Asimov knows that tethers aren't a good thing. Yeah, I have read that. And your point on nuclear powered submarines and the lack of disasters that have happened there, at least that I've ever heard about, just seems such a compelling example for how this can be a sustainable way to produce energy. Are we still riding on kind of mass fear from Chernobyl and Fukushima? I mean, do you think there's a real legitimate concern? Maybe I'm blind to it, but everyone I talk to seems to have a conviction about the safety of the technology if it were produced in a way that were standardized and regulated and done correctly. I mean, what's your sense? Is that why things are not moving forward faster and we're kind of decreasing energy usage by nuclear? Well, so, government officials depend on being elected to hold office. And so they have to do things that their constituents believe in. And, sometimes these hard decisions go against the grain. Now, the first SMR that will be licensed, I believe, is in Wyoming. And I think it's scheduled to be operational within this decade. So you can kind of see how long that takes. Now, you could, in theory, set up SMRs as long as the federal government would approve the license. I'm sure First Nation tribes would love to have SMRs on their reservations and generate power and sell it to the world. That would be, great income source for them. Yeah. Because they don't suffer from the, state and local issues. They're sovereign nations, right? But I think you will see SMRs start becoming deployed. I think you'll also see fuel cell technology. Now, the issue is most fuel cell systems run on hydrogen. Hydrogen's, very difficult to transport. If you think natural gas is hard to transport, hydrogen's much harder to transport. But I think we're starting to solve the hydrogen transport problem by looking at essentially creating a solid form of hydrogen, which call it solid state hydrogen, which is there's some technologies that have now been proven that allow you to kind of bind hydrogen molecules to materials so it becomes stable in nature, and you don't have to keep it in these pressure vessels, which can blow up and have Hindenburg events. So I think you're going to start seeing hydrogen fuel cell technology becoming more prevalent as well. Now what you can do is you can take a solar plant or a wind plant and you can essentially electrolyze hydrogen. So you have green hydrogen. as opposed to what's called brown hydrogen, which you do from natural gas. So you're still creating pollution when you do that. And you can mix hydrogen and ammonia together to transport it if you need to. So I think there's a model where, over the next 10, 20 years, you're going to see large solar farms being built in places where there are no consumers for that power, where they'll essentially have hydrogen being made. And, I know in Saudi Arabia, the city of Neom, which is a modern city being conceptualized by the government, which will be all renewable, is going to have a lot of solar energy generating hydrogen, for example, and becoming, I think, they want to become one of the largest exporters of hydrogen in the world. So, that's clearly, an opportunity as well.
That's interesting. Did you, when you joined Marathon, did you dive into energy? I mean, do you think of what you're doing as becoming an expert in understanding energy production and trends and effectively allocating capital to invest in those places where energy is most efficient? Or how do you sort of think about it? Because you're riding right on the spike between crypto and Bitcoin and energy production. How do you think of what would make you successful?
So, obviously, keeping tabs on energy markets, generally speaking, there's kind of the short-term horizon, the medium horizon, and the long-term horizon, right? So the long-term helps kind of indicate, what we should be thinking about in the kind of 5 to 10 year distance. Medium term, it's really, you're thinking more about a combination of regulatory and just global energy markets type stuff. And short term, it's really more hosting capacity and where is there some stranded energy I can get a hold of. So, our planning horizons, if you think about it, are, am I in a mode where I'm deploying a lot of miners, then I'm focused on deployment, which is what we're doing right now. And, I'm keeping an eye on the medium-term regulatory environment, the energy regulations, energy pricing markets, energy types. And then I'm also keeping an eye on the long-term outlook of, where is there going to be really inexpensive energy that's reliable? And what should I be thinking about to position myself properly for that? Should I be thinking about investing in the energy type? Should I think about, potentially partnering with an energy provider that's going to build that out? I personally believe, and I've been saying this for about a year, that, energy is the single biggest input cost to Bitcoin miners. And so it behooves Bitcoin miners to partner directly with energy companies, and eventually for energy companies, maybe to just become Bitcoin miners. Because if you have stranded energy as an energy company, well, be your own customer and consume it, turn it into money. And if you can't sell it to a consumer, turn it into Bitcoin, which is the next best thing. And I think you're going to start seeing more and more energy companies actually saying, we'll take a percentage of our capacity and we'll mine Bitcoin with it.
Yeah. I interviewed a guy who took over they have 3 power plants in Pennsylvania, and they are coal power plants. And apparently at the turn of the century, they're able to cultivate this old coal. And it was just a power plant that was, taking there's 200 plus coal mines across the state, and they just take all this coal and burn it, and they bolted on some crypto Bitcoin miners, and it worked. And interesting story. So I love the different types of stories that come up on Bitcoin mining, because that's going to be his thing, being in Western Pennsylvania and having this coal mining plant. But then there's so many other different applications where you have stranded energy. Which is really interesting to see. And how do you do that? Do you stay up on all the news? Do you have an analyst on the team who sort of presents this news internally? Tactically speaking, do you guys have meetings where you'll sort of map out the way that the energy usage is going, or external agencies that help you think through this stuff?
Yeah, so we have an advisory board where we have experts across a variety of specializations, semiconductor technology, ASICs, what's happening with Bitcoin ASICs, et cetera. Regulatory experts. We have energy experts that we rely on. And we're constantly talking to, the energy markets and, what are you seeing in the way of pricing trends? Where are there facilities that may be stranded? Now Marathon specifically focuses on ideally renewable energies where we're trying to source all our power from. So, that kind of narrows our window, if you would, or the lens that we look at things through, because we're trying to get away from anything that's kind of fossil fuel related, because we just think it's better for the environment. But you rely on a lot of experts to continually feed you information. You have to read a lot, and we're obviously also dealing with the regulatory environment. So you're talking to a lot of people in Washington and at the state levels regarding things to make sure that you're being a good corporate citizen where you're locating your facilities, and you're a good energy citizen relative to the energy utilities that you're buying the energy from.
Yeah, makes sense. Anything you want to throw out there? Any other tidbits or things that you've learned or have been interested in, or otherwise, if there's places on the internet that you write or you tweet, anything you want to throw out personally? We'll have all the links to the company in the show notes.
Yeah, I mean, I would just say that I think what's interesting with markets is they're constantly in states of evolution, and Bitcoin mining industry is in a state of evolution right now, and it's going through this kind of natural and very healthy process of evolving from a kind of wild west where there was this great opportunity. Think of it as like the oil business at the turn of the last century, right? It's a marketplace where the John D. Rockefellers of the world kind of made their fortunes, and then it got regulated, and now it's a much larger industry and operates in a much more mature fashion. So I think you're going to start seeing the rest of these industries go through that same spot. But we're super excited about what's going on in the industry. We're very proud to be able to play a role in this industry and how it develops, and we're really looking forward to seeing how the crypto world and Bitcoin, more specifically, really help lift a bunch of people out of poverty who otherwise don't have an opportunity to have bank accounts and financial systems. And we're glad that we're able to operate a good portion of the Bitcoin network and provide security and transaction processing.
Yeah, well, congrats on the progress, Fred, and wish you guys the best. I really enjoyed the conversation. Thanks for hopping on.
Thank you very much.
All right, cheers.